VP Refining, Chemicals and Oil Markets and Downstream Global SME and Commodities Research at Wood Mackenzie, and Andre Bellier, Professor and Founder and CEO of Belsen. Thanks, gentlemen, for joining us on June the 25th. Tuesday it is. A good day with Julian Assange, at least in my opinion, finally being freed after 10 years of being holed up in the Ecuadorian embassy and Belmarsh prison. A good day for journalists anyway, freedom of the press. So that's good news. But let's get on to the current affairs of the energy markets. Robin, let me start with you. Our first sort of headline there in terms of news articles is oil prices steady. Despite this, despite that, we have, we've seen a rise in the last few weeks, a gradual strengthening of oil prices, but we're still in that 80s range, aren't we? Not really nearing 90 yet, which is supposedly what OPEC would ultimately like to see. And we had a question that we put to our audience yesterday where 85 to 90 is what's expected in the third quarter. Would you agree with that? Do you think we're going to see that push up in the next 3 months, and why, if so?
Well, we've been in this range, this kind of 75 to 90 range for quite a long time now. Been, remarkably steady, really. I think we've seen some tentative signs pushing a little higher in the past couple of weeks. So 85 to 90 range, yeah, that's reasonable, defensible. Whether we'll go much higher than that, I think doubtful for now. We still remain in a situation that the main factors are very much in balance. Geopolitical concerns are there, but are kind of largely discounted. The market is remarkably unworried by those still. Demand has certainly picked up a bit, but the demand picture is still very patchy, depending where you look, whether geographically or sectorally. So yes, I think that 85-90 is probably the best to hope for now.
Okay. And I mean, Alan, we had a couple of comments yesterday on our podcast that, yes, third quarter should give oil prices a push because of summer demand, etc. But also, one of our commentators was saying that the excess of products, Middle East products in particular, he was emphasizing into the market, exports, is going to sort of put a dampener on crude to an extent, because it'll obviously lessen indirectly demand for more crude, for more refining globally. Would you agree with that? What's from a refinery point of view? Are you seeing plentiful supply, or should we expect any shortages in the summer?
We're very much, firstly, sort of our outlook is sort of crude 85-90 as we go through Q3. We have got some strength. We've got stronger crude runs in Q3, reflecting sort of peak seasonal demand. So it's that usual seasonal pattern. But if you look at refining margins, the unprecedented levels of 2022, 2023 have gone, actually. So the way we do our sort of composites, they're actually now below the 5-year average. So there is plenty of product around. So the concept of replacing crude with product, well, in terms of what the Middle East is exporting, which I think was the comment yesterday, there is some sort of validity on that, but it's still demand on crude. It's just how you're tracking call on crude, maybe in terms of Middle East exports, because some of it is being converted into products domestically and those are being exported. But at the moment, plenty of product around, margins, below that 5-year average, and we haven't got them dramatically recovering for the rest of the year, because we haven't got a huge amount of demand growth. A lot depends on how, say, the Dangote refinery starts up, when that gets to full operations, because that'll change the dynamic of gasoline in the Atlantic basin.
Okay, and there's no, like, we do have a news article on that saying that they're trying to. Dangote is claiming oil majors are trying to sabotage the refinery, but obviously that is a big player, isn't it, in terms of supply? And what would that, I mean, what is the indication there? What is the expectation of the market, that within a month it'll be back up and running? What's the what would you gamble on?
Having done a couple of refinery startups, I'm not sure I put my money down, because when you're in them, you don't really know what goes next, because there's so many things going on. It's very hard to be accurate in terms of the forecasting. But the Dangote is running crude now. It's nominally 50% utilization. It's exporting jet fuel to Europe. The quality of its diesel is improving in terms of lower sulfur content. It's all when the RFCC, the residue FCC, comes on, because that's the big gasoline producer. And in a sense, that's what Nigeria wants, as that's mainly what Nigeria imports. So it's when that becomes operational and stable, that's when it starts to change the pull on European gasoline down into West Africa. And so we've been holding out that we think that starts up next month. Time will tell. We'll see. Yeah.
Thanks, Alan. Andre, good morning again. Let's get your point of view on Europe. And we have, again, a gas headline here. EU gas could be looking at some pressure in terms of, obviously, that we've got lots of, obviously power demand now with the heat in Europe, etc. I mean, is there any sense in Europe that there is going to be excess demand for that Europe will start to feel the pressure of gas prices when it's had a relatively calm period for the last year and a half, compared to, obviously, post Russia, Ukraine, the beginning of the war, etc., and what happened there? What's the sense as we go into the second half of the year in Europe for gas demand, gas prices?
Obviously the situation on the markets is way easier than used to be 2 years ago. So basically the gas demand is lower than 2 years ago, and certainly the portfolio of imports is way more diversified. And at the same time, we also see that, for example, some efforts in, on one hand, phasing out Russian gas by Europeans, and on another hand, by Gazprom to get out of the European markets, they remain more or less relative, because we see that gas inflows by pipelines not only continue but even increased over this spring. However, the European Union feels confident enough in terms of security of supply, and therefore there are proposals to actually sanction the Russian LNG imports.
Okay, yeah. I mean, Robin, back to you on Russia. We talked to Andrew was commenting on gas, but what about oil? Continuing obviously to flow, but have these sanctions by the EU, by the US since the start of the year, the extra sanctions on shipping and, the possible problems with payments of certain buyers of Russian crude, I mean, has that started to have more of an impact than it did a year ago, let's say, or 6 months ago? Are we beginning to see any impact from these sanctions at all? We had somebody on from Lloyd's List yesterday saying there will be more impact. They expect that this will start to bite the Russian purse.
Well, a few different things going on, right? As you say, there have been various phases of sanctions, and those have each of them, I guess, has a temporary effect. And then usually the Russians will find a workaround to it. There was that period a few months back when the cargoes into India were quite severely disrupted, and there was a whole queue of tankers waiting to get into India. Eventually that was resolved. And then there's other moving pieces as well. One of it is, of course, that the Ukrainian attacks on Russian refineries, those have taken some refinery capacity offline. So far, not a major overall impact. The refineries are being repaired and coming back. But if that Ukrainian campaign continues and perhaps evolves, then maybe we'd see more Russian refinery capacity taken offline for longer periods and getting harder to repair. Maybe. But I think as far as the sanctions go, the latest package of sanctions had a pretty significant impact on the Russian financial market and a pretty significant impact on the foreign exchange market for Russia. Not so much on the oil market. Exports are down a little bit, but I think that's really seasonal plus a bit more effort on OPEC compliance rather than any major impact of sanctions. What I do think is worth watching is the whole tanker situation and this move by Denmark to look very hard at the compliance of tankers with sanctions and with insurance, because of course we have a major part of Russian exports still going out of the Baltic and going past Denmark, and growing concerns over the safety of tankers in the Danish Straits, and what if there's an accident and the insurance is probably not worth the paper it's written on. So if the Danes and the EU backing them up were to put more restrictions on Russian tankers out of the Baltic, that could really hamper flows, because there's really no alternative to that route. Okay, so we might start to see that bite. Alan,
let's talk a bit about China and products, because we had China set its product export, refined product exports, quotas for the full year ahead earlier this year, and of course you've got the domestic demand situation. What are you seeing there in terms of balances of how those refineries might be planning for domestic demand, given the economic outlook there, and the potential for exports into the region? I mean, have we seen a change and shift in the last couple of weeks? And what are the expectations for sort of Q3 and Q4 for China exports?
For Chinese economy hasn't materially returned to growth, and there's a degree to which how you measure that. Because if we look at Chinese distillate demand, it's not particularly great, not particularly strong. There is a challenge in that actually there is akin to what China has done around electrification of the passenger car fleet. They are shifting trucks onto LNG, and so something like 25% of new heavy duty truck purchases are LNG. So if you're in a sense, so we're having that move decouples the manufacturing of movement of goods from diesel demand, just that activity of changing their fuel type. What we've seen in terms of the export quotas is sort of less than 2020, less than 2023. In terms of the numbers, we're expecting more exports in Q3 compared to Q2. Predominantly gasoline, because that's typically sort of when gasoline strength is. The nagging fear that we have, or nagging concern that we've got, is our GDP outlook suggests China isn't going to hit its 5% number. If I think of our sort of house view on Chinese GDP growth, if that becomes more increasingly apparent, then actually it may well be that refining for exports is a way of providing a short-term boost to the economy. So at the moment, what we're looking at is, in terms of what's been proposed, exports being lower this year than last year. However, it may be a little bit. We may come to the end of the year, and the need for GDP numbers pushes more exports. So that's one of those nagging concerns we've got about sort of refining margins towards the end of the year, is how much China pushes out if GDP is more aligned to our forecast compared to what they're sort of expecting.
Yeah, and thanks, Alan. Robin, back to you. What about what OPEC is expecting? Because again, we continue to see their demand forecast much more bullish than others out there, as they have been all year, but no major adjustment. And what is the outlook for China from your perspective? Is it steady as she goes to the end of the year? We will get 5% growth. We've seen some stimulus come in, but from an OPEC supplier point of view, if you like, given their concerns also with non-OPEC competition, do you think they'll adjust their expectations from a demand point of view as we go into the third quarter?
Well, look, I think part of this, the discussion we started with, why we kind of range bound on oil prices some of it more recently goes back to the OPEC decision, because that brings oil back on the market in a pretty steady and phased way. But there is always the potential to stop those return of production if the market outlook doesn't favor it, right? So for me, this put a cap on oil prices both on the upside and the downside, giving that kind of flexibility. And it's certainly kind of, for me, ruled out, except in exceptional circumstances, the kind of $100 plus scenarios, because then OPEC would definitely be bringing back production more quickly if Chinese demand really surprises to the upside. I think on the Chinese demand, agree with Alan. The growth targets are probably a bit over ambitious, and the Chinese demand picture has kind of pockets of weakness and pockets of strength, but it's not terribly exciting overall. And the US picture is, I think, somewhat similar. If you look at the jet situation, looks pretty good. If you look at diesel, it's weak. So it's hard to come up with a really robust story from either of those major consumers. And then the European situation is definitely weak, particularly on gas oil. But if you go back to the kind of that OPEC question, they have that kind of flexibility. I think they've had these very high demand forecasts for a while, and they continue to stick to them. The IA figures you may feel are perhaps a bit low, and likely to be revised upwards. But we're now approaching the third quarter, and we still have this very aggressive OPEC forecast that is not shifting. I think people are looking increasingly and thinking, surely OPEC is going to have to trim those demand forecasts a bit quite soon.
Yeah, thanks, Robin. Andre, let me go to you because you are sitting in Europe, and just to get a sense of, I'm not going to quiz you on monetary policy because that's not your specialty, but the general sort of economic mood in Europe. I mean, Robin just said gas oil demand, which indicates industrial demand isn't that great, but things have kind of seemed to have improved compared to a few months ago. The situation in Germany might be a bit better, but from a European economy point of view, do you expect, we're seeing the stock markets perform very well. What is the sentiment there in terms of second half performance, possible industrial, improvement in production there? And also, given that the European Central Bank has started to cut interest rates, whereas the US hasn't, is that all playing into something positive for demand ultimately?
Well, there are some positive trends, and they are related to the fact that the peak of the crisis, the most difficult period of the crisis, is actually behind. And indeed, the energy price, particularly gas price, is way lower, but that basically also triggers a lower carbon price. They are quite correlated together. They moved since the year 2020 very much one pushing another. And now once the gas price declined, carbon price also declined. And that definitely eased inflationary pressure. Having said that, it doesn't mean that the situation is like rosy, etc. There are a number of issues, and industries have not, several industries have not recovered from the crisis, and that basically creates an issue of overall longer term policies, especially in regards of the new European Union political cycle, which starts now in June, and what to do with industrial policy, what to do with the energy transition, how to mitigate social costs. And then at the same time, there are some postponed effects. We are observing now very worrying and triggering elections in France. Yeah, that are the result of the crisis. And if French politics turn into a bad politics, then we may have a spiral effect when a crisis in the past is amplified by inaccurate policies of tomorrow. That's why I would not be too much optimistic, but certainly the most difficult part of the crisis is behind.
Yeah. And of course, those EU elections happened recently, and we do have a lot of we have a UK election coming up. We have the French crisis, if you like, political crisis. Alan, I won't ask you about the UK election, but I will ask you to give us your also a bit of point of view on other commodities. We've talked about oil and gas, but give us your take on other, base metals, etc., which have had a very good run this year. Despite some economic slowdown in general, but we had a very strong first quarter, didn't we? What outlook for commodities as we go forward with this inflationary sort of influence, if you like, looking much stronger than oil, right? Continuing to look much stronger in comparison.
Yeah. There's a couple of factors going on. Before I get to the commodities thing, it's just to go back to sort of the point on OPEC and oil demand growth. Because they have been remarkably resilient in their number, and we've been revising numbers down because the first half of this year has been particularly disappointing. It's only kind of May that US gasoline demand was higher in 24 than 2023. So the 2.2 now looks quite aggressive. Yeah, and to Andre's point, one of the things that the risks that we see for Europe is the uncertainty associated with the French election, in terms of there's quite a disparity between there's the risk you end up with sort of either side being quite extreme with different degrees of stimulus that's put in place, and that's having impacts on credit spreads and all that entertainment. And as Andre said, that could then filter into the European Union and how those policies work. In terms of sort of the base metals, there's this broad theme that's in the background, which is ongoing electrification and the requirements that has. Copper's been sort of incredibly strong, but come off. So there's that ongoing mega trend of broad electrification that isn't happening at perhaps the pace that many people would want, but is still underway. And metals are much more difficult to ramp up in terms of supply and far less of a surplus than what we see with OPEC and its achieving its market balance.
Yeah. Thanks, Alan. There's our survey question for the day, which was addressing a point we were discussing earlier, in excessive refined products exports, and particularly like we were discussing about the Middle East refiners, which with new capacity having come on there, will keep crude prices under $90 in Q3, i.e. it will limit demand for crude because there's plenty of refined product. Agree or disagree? Let's see what we get with that. Robin, I mean, a couple of points I want to touch on with you. I do want to address the geopolitics again, but on the electrification matter in Europe, for example, we also had elections recently, and that might impact, this trend, enthusiasm or lack of it for the transition. Europe is ahead of everyone else. But we also see this battle with China on tariffs, EU following in the US's footsteps in terms of tariffs on EVs. Where do you think Europe is going in terms of its transition policy going forward, given energy security concerns, given tariff issues with competitive green energy and green energy supply from China? I mean, how positive are you going forward about this? Do you see a change in policy, if you like, on that, now that we've had the elections as well, with those results coming out in Europe?
Yeah, look, there are a few different, again, moving pieces moving in different directions here. And you have some countries, France may be one, we will see, which are, moving in a more rightward direction. And overall, that was the trend of the EU elections, and a more skepticism on net zero and so on. But you got other countries, moving the other way. If you take the UK, not in the EU, of course, but still a European country, which is absolutely, seems pretty clear it's moving in the opposite direction. So it's not a completely clear-cut picture here. And I think on Europe's kind of push on net zero, really depends where you look. But a lot of the pushback on net zero things is around things like agriculture, which is important, but not on the energy side. The net zero policies there are not impacted so much. There are things like the policy on EVs. When should there be a ban on combustion engine vehicles? I think the EV train has left the station. That they are growing so quickly and becoming more competitive. I'm not sure government policy is really the key thing there anymore. And similarly on the power sector, I think the direction of travel towards more and more renewables, it might be a bit quicker, a bit slower, but I think the direction of travel is also pretty clear there. I don't think anything is bringing coal back to Europe in a big way. No matter what government comes in. If you look at Poland, very coal heavy, and Poland is absolutely trying to get off coal. So I think that policy line is pretty clear, regardless of the movement of these elections. And if you look at Europe's policy on EVs and on China, I think it's actually more nuanced. It's more moderate than the US policy. The US policy is pretty clear. The tariffs are so high, they want to keep out basically any Chinese vehicle. Want to make sure it's just completely uncompetitive in the US, and then they'll increasingly go after this Chinese supply chain and Chinese companies trying to build in Mexico and export to the US and so on. They'll try and clamp down on those too. The European policy is more to say, there's a significant tariff, but not an impossible one, given what Chinese vehicles sell at. Chinese vehicles will still probably be able to be sold in Europe and still competitive, but it does give some protection to the EU industry to build up their own phase and have their own manufacturing capacity and have a more mixed market of Chinese, European, and no doubt other vehicles.
Okay, thanks, Robin. Andre, let's just touch on geopolitics a bit in our final few minutes and talk a bit about Russia, Ukraine. I mean, again, you're in Europe, you're not in either one of those countries. But the stalemate that has set in a while ago seems to be getting deeper and deeper, despite the fact that we saw some extra military aid and a financial aid come from the US earlier this year. That was the big sort of meant to be the possible transformative moment. Too late, too little, too late, perhaps. What is the sense in Europe today as to when and how this conflict can end? Are we into now a few years of stalemate? If you had to bet on it, what would you say is the end game here? I mean, given what's happening with the Russian economy and how it might be suffering from a revenue point of view, given Western aid, etc.
Well, I think predicting anything here is a little bit like when you have a hurricane and you are planning to rearrange your garden after the hurricane. But what is important is to see what the hurricane leaves before you start thinking of rearranging the garden. We don't know what's going to happen. Anything can happen. And I would not dare to predict anything on that. And regarding your first question on European sentiment, they are very much divided. There are very serious concerns, security concerns, whether Russia represents a risk and a threat, either by winning over in Ukraine or by, on the contrary, losing and engendering a collapse or a crisis inside Russia. Concerns are different, concerns are divided, and therefore, even in the French politics, we see that now it's very important and insightful to observe these debates, the pre-electoral debates, because they are intentionally or not intentionally touching upon Russia. And one of this specific tension. And one of the interesting cases that I actually remarked, that the far-right party, which is Rassemblement National, by Marine Le Pen, who used to be very much traditionally close to Kremlin, one of her main, let's say, campaigner, the head of the campaign, Bardella, recently stated that France cannot leave NATO military commandment as long as the war is ongoing, because Russia represents a risk and is actually threatens French interests in Africa. Is it a shift of discourse, or is it just an attempt of a populist party to assemble, to make a catch-all politics, to take everybody, like those who are let's say, Russian verstehers, or those who are also concerned about it, like kind of like catch everybody? Or is it a sense of realism, understanding that, okay, one thing is what you're talking to the population, and another thing, once you are holding, for example, either a Minister of Defense or a Minister of Foreign Affairs, what you actually do. So, anything.
Well, Europe, and Europe certainly seems to be stuck, doesn't it? I mean, they've tried their best, but nothing seems to. I mean, there's a lot of uncertainty anyway, and obviously that's impacting the economy as well in terms of investment. There's our survey. Excess refined products will keep prices in check. So not surprising, probably 71%. Robin, I just want to go back to you just to talk about the region here where we are. You and I are. We're in the Gulf, and we've obviously we continue to see the horrific events in Gaza. But also, some escalated rhetoric around the Lebanese-Israeli border. And we haven't heard much from Iran the last month or so, despite the fact that we have elections coming up there. Is it still all quiet on the Mideast front in terms of regional escalation? I mean, geopolitical risk is still at zero. What do you think?
Geopolitical risk is always there, unfortunately, but the energy markets seem to rather overlook it. I mean, look, we're in an amazing situation here where the Red Sea has been shut down to most shipping for months now, and people just reroute around Africa, and of course shipping rates go up, but the energy market is largely unmoved by this. The Iranian elections, I don't think any big change, and even if Pezeshkian, the more reformist candidates elected, I doubt that would be a big change. And the hardliner, well, we just had a hardliner, so it wouldn't be a major change if we get another hardliner. But I do think that the Lebanon-Israel situation, of course, is very worrying, and that's the one with potential for obviously a lot of destruction to both countries, and you know, would obviously be a disaster of policy if it actually happened, but some voices seem to be pushing for it. But energy-wise, absolutely could have some major consequences throughout the Eastern Med and the gas sector there, and draw in other countries like Egypt.
Okay, thanks, Robin. Alan, we'll give you 1 minute just to give us, I mean, Robin was mentioning the rerouting because of the Red Sea, etc. Give us your assessment there on, you know, product markets in particular, how those have been impacted with this continuous pattern now that's here to stay for the time being. You know, tankers making their way around the Cape of Good Hope and using other routes. But again, apart from shipping rates, much disruption to products thinking?
Little. There was some initial disruption in the early weeks because you had a lot of product on the water, so inventories normally drew. So we had some pricing strength. Most sort of middle distillates going from east to west is going around Southern Africa. A lot of Russian product continues to flow safely through the Red Sea because we're tracking all the ships. It's largely the markets, that is now the new supply chain. Freight rates are a little bit higher. We're seeing a little bit increase in bunker demand because ships are sailing a bit further. But in a sense, it was a very minor speed bump in the road that the energy market has gone over, and it's just now part of the normal flow pattern. So if it unwinds quickly, we could have an impact on refining margins because all of a sudden you get large building inventory in sort of the destination places, but the market has just dealt with it, and it's just part of the normal day-to-day scheduling.
Okay, thanks very much, Alan, for that. And Andre and Robin, thank you so much for joining us all this morning, and have a great day ahead.
Thanks, guys. Enjoy the rest of your day.
Thank you.
Bye-bye.
Thank you.
Thank you. Bye-bye.
Thank you. Bye-bye.